Good afternoon and welcome to Carr and Ingram's 2021 year-end tax planning. In this webinar, we're going to discuss how businesses can strategize, optimize, and maximize for their 2021 taxes. In this webinar, you're going to learn different strategies and opportunities that you may not have thought about that you can discuss with your CRI tax advisor, either as 2021 winds down or to let you know what to expect as we begin 2022. Before we get started, let's handle a few housekeeping items. First, if any of you are needing continuing professional education credits, this webinar does count for 1 credit hour of CPE. To get that 1 hour of CPE credit, you have to be in attendance for at least 50 minutes. You have to be logged in under your own unique link, and you have to answer at least 80% of the polling questions. Now, if you meet those criteria, you should receive your CPE certificate about 7 days after the webinar. If you haven't received that certificate after 7 days, feel free to reach out to our marketing team at marketing@cricpa.com. If you check your chat section of your Zoom webinar, you'll also see a link of how you can download the slide presentation and get handouts if you like to follow along in your own version of the slide deck. Additionally, you should receive an email within a day or so after concluding this webinar that will also have a link to the slides as well as a copy of this recording itself. If you have any questions during the webinar, feel free to enter those in the question and answer section of the Zoom platform. We'll try and get to as many questions as we can get to during the course of the presentation itself. So feel free to go ahead and enter those questions as they arise. So before we get started, let's go through the presenters and make some introductions. First, I'm Chris Hoffman. I'm the tax service line leader here at Carr and Ingram. I got my master's degree from the University of Tennessee, and I enjoy watching my Nashville sports teams, the Tennessee Titans and the Nashville Predators, as well as my Tennessee Vols, of course. Each year I take a beach vacation to Hilton Head, and I have 2 Boston Terriers at home. Also presenting today is Dan Sellers. He's a partner in the Birmingham practice office. He got his master's degree from the University of Alabama, and he enjoys watching the Crimson Tide. He enjoys many things in the outdoors like boating and fishing. And an interesting fact about Dan is he's been a guest on a radio show with Coach Nick Saban. Also presenting today is Gigi Lott. She's a partner in our Mobile, Alabama office. She got her bachelor's degree from Birmingham Southern College. She serves on various boards, including the board of directors for Point Clear Rotary, and is actively involved in several local nonprofit organizations. Now a quick overview of what today's webinar is going to cover. We're going to start out with the employee retention credit, really focusing on how it's been expanded and changed. We're going to touch briefly on the Paycheck Protection Program as well. There's also been a pretty significant change in the deductibility of business meals that we'll let you know about. We'll then cover some of the pertinent areas of the American Rescue Plan Act, or ARPA. We'll then move on into some of the Small Business Administration SBA assistance programs. We will conclude with the net operating loss rules under the CARES Act. And then, time permitting, we'll cover any questions and also touch on how the Build Back Better Act and where that stands. And with that, I will pass it off to Dan, who's going to get us started with the employee retention credit.
Thank you, Chris, and thank you everyone for joining us this afternoon. I'm going to start with the employee retention credit. As Chris mentioned, there have been some significant modifications to this credit from when it was originally passed in 2020 under the CARES Act into 2021, and we want to touch on a lot of those modifications. Originally under the CARES Act, when the ERC was passed, if a business received loan funds under the PPP program, you were not eligible for the ERC. Under that Consolidated Appropriations Act of 2021, that law expanded and allowed people that receive PPP funds to also qualify for ERC. And so that significantly widened the pool of businesses that were eligible to receive these credits. Obviously, this has been a big boon to businesses that qualify, providing cash flow to many businesses in a time of economic uncertainty. As with most new government programs, however, there are many rules and potential pitfalls, many technical guidelines surrounding eligibility, how to calculate the credit, how to claim the credit, and even some income tax considerations that we need to consider. So we're going to go through all of those changes on the following slides. One common theme that you're going to notice as we go through these slides is that the guidelines are very different based on whether your qualification period is in 2020 or in 2021. In some cases, your business may even be eligible for both years. However, the different guidelines remain in place. So, some of the eligibility requirements that we're going to cover, the two primary eligibility requirements, one was that your company's operations must have been fully or partially suspended due to a government order. Or the second one is that the company suffered a significant decline in its revenues. And that definition of significant decline in revenue, again, is very different based on 2020 or 2021. For 2020, that decline is defined as 50% during a calendar quarter. And for 2021, that was changed to be 20% during a calendar quarter. And to clarify, in 2021, that comparison period is to the same quarter in the year 2019. So as you can see there, the enhancement there greatly broadened the pool of businesses that might qualify. One other item to talk about here is that the rules are much more lucrative for eligible small employers. And under the 2020 credit, that eligible small employer is defined as having less than or equal to 100 full-time equivalent employees. In 2021, that again was enhanced to include employers with 500 or fewer full-time equivalents. And as we move on to other slides, we'll talk about what exactly makes that more lucrative for those eligible small employers. And I believe we'll get to that right after the poll question.
Okay, thanks, Dan. First polling question. A business qualifies for the 2021 Employer Retention Credit if all employees were hired in 2021? Is it if all employees were retained in 2021? Is it if gross receipts declined by 20% during the 2021 quarter as compared to 2020? Or is it if gross receipts declined 20% during the 2021 quarter as compared to 2019? Let's give everyone a few moments to respond to that polling question. And in the meantime, we had a question come in, Dan. Can a sole proprietor qualify for the Employee Retention Credit?
That's a good question, Chris. And generally, you have to have payroll and you have to have employees under you and be filing payroll tax returns to qualify. So a sole proprietor, I do not believe would qualify.
Thanks, Dan. Let's go look at those poll results now. So 54% of the audience say you need gross receipts decline of 20% during 2021 versus 2019. 33% say 2021 versus 2020. Dan, can you clarify that for folks?
Absolutely, Chris. D is the correct answer. Again, that 2021 qualification period, you're comparing your 2021 quarter to the same period in 2019.
Okay, thanks, Dan. I'll pass it back off to you to continue with the ERC.
Okay. Well, as we mentioned on the previous slide, the credit is much more lucrative for those eligible small employers. So let's talk a little bit about what that means. So if you are an eligible small employer, most all of your employees are eligible. There are some exceptions for certain owners and certain owner family members that do not qualify, but generally all of your other employees and their wages would be eligible. If you are not an eligible small employer, only the wages paid to employees who are not providing services qualify for the calculation of that credit. So as you might imagine, that drastically reduces the scope for those that are not eligible small employers. So we've talked about eligibility. So let's move into how you calculate the credit. And again, you'll see this breakout of how it's calculated for 2020 as compared to 2021. And I think you'll see pretty clearly how the law was enhanced. So for 2020, the maximum eligible wages per employee is $10,000 per year. And the credit is 50% of those eligible wages. So the maximum credit per employee is $5,000 for the entire year. As you move to the 2021 credit, one of the largest enhancements was that is $10,000 of eligible wages per employee per quarter. Also, the credit amount was enhanced from 50% to 70%. So as you can see there in the example, if you had $10,000 of eligible wages in a quarter, 70% of that is a $7,000 credit per employee per quarter. So just to quantify that change, if your business qualified for 3 quarters in 2021, then the maximum credit would be $21,000 per employee. That's $7,000 each quarter, as compared to a maximum of only $5,000 under the 2020 law. So as you can see, a pretty significant enhancement there if you qualify. Okay, so if you qualify, if you're eligible, if you've calculated the credit, how do you claim the credit? And the credit operates as a refund of payroll taxes. So you claim the credit by either filing a timely filed Form 941, which is your quarterly payroll tax return, or most likely you'll be required to amend your original 941. Now, in practice, what we've seen is that if you're amending your 941, it could take several months for the business to receive the refunds once that gets filed. And what we believe is this is primarily due to the unprecedented delays that the IRS is seeing in processing, paper returns. We've dealt with that on many other paper filings, and we believe it's the same thing here. Now, if you were one of the businesses that were able to claim the credit on a timely filed return, which you can file electronically, we have seen that the credit could be paid, pretty timely within 2 to 4 weeks. So one thing that changed fairly recently, like over the weekend, as Congress pushed through the infrastructure bill. And I believe, as we talked, maybe that's still sitting on President Biden's desk, but it seems to be a formality at this point. this credit was originally scheduled to go through the end of 2021, but the infrastructure bill, if signed into law, will terminate this program at the end of Q3. So there would be only 3 quarters that you could qualify for in 2021. The other thing that you need to consider on the ERC is that it is considered a taxable credit. And what I mean by that is, as with most tax credits, you're using a wage expense to claim that credit. So you cannot deduct those wages if you're also getting a credit. So still a major benefit, but to get the full picture, you'll need to take the after-tax impact of that credit.
Okay, great, Dan. Looks like we are up to our next polling question. So let's get that started. Polling question 2, the 2021 employer retention credit. Is it only available to businesses with less than 100 employees? Does it apply to all wages paid to an employee of an eligible small business? Is it equal to 40% of eligible wages? Or does it expire in December of 2022? Well, everyone is having a moment to respond to that polling question. We had a question come in, Dan. Can you give an example of when a larger business has to pay an employee who is not providing services? Can you provide an example of what that may look like?
Sure, Chris. So that would be, if a large employer kept someone on payroll, retained someone on payroll that may not actually be working. So think of a furlough or a layoff or in a certain term where they're still being paid, but not actively working.
Great. Thanks, Dan. Let me end the poll and look at those results. Let's see, we've got 53% of the audience say the 2021 ERC applies to all wages paid to the employees of an eligible small business. 21% say it is only available to businesses with less than 100 employees. Dan, can you clarify that for folks?
Sure. Yeah, B is the correct answer. And I'll just clarify there on choice A, the credit is available to those that have more than 100 employees under the 2020 law or more than 500 employees under the 2021 law. It is just significantly reduced in its scope.
Okay, thanks, Dan. And now I think we are going to have Dan tell us about the recovery startup business aspect of the ERC.
Okay, so the next 2 slides are going to cover some unique provisions that were in the expanded ERC program. So they're pretty narrow in scope, but they could be impactful if you qualify. So the first is this ERC for recovery startup businesses. So if your business started operations after February 15th of 2020 and you have average annual gross receipts under that $1 million mark, then there is a special ERC credit available for you. If you qualify under this program, you're not subject to the revenue decline or suspension of operations test. This credit is only available for Q3 and Q4 of 2021. And keep in mind, with the recent passage of the Infrastructure Act, I believe this will be the only provision that is eligible for in Q4 of 2021. But it is limited to $50,000 per quarter. So it's a $100,000 maximum benefit. And there is one more sort of unique provision in this program that's for severely financially distressed employers. So what this does is it provides a benefit to those businesses that have more than 500 employees. So those that are not eligible small businesses, but they can show a 90% decline in gross receipts. So obviously that would be a large business that has been pretty severely impacted. So under this provision, if you qualify, it sort of treats all the employee wages as if you are an eligible small business. So it allows you to treat all those employee wages in calculation of the credit, not just for those not working. But this one, this provision is only for Q3 of 2021. Okay, so that covers the ERC, and we wanted to take a minute just to have a quick refresher on the Paycheck Protection Program. I know there was a lot of material in 2020 on this, but I know a lot of businesses will be dealing with the actual forgiveness as they're preparing their 2021 tax returns. So we do think it's relevant to kind of just have a refresher on this, but we won't cover much. So just to reiterate, the loan forgiveness is considered a non-taxable event. There was a lot of discussion last year about whether it would be taxable or non-taxable. We got the answer late last year in 2020, so I wanted to reiterate that. And also another key point is that loan forgiveness is going to increase your basis in line with other non-taxable income items. So again, just a quick refresher on that.
Okay, thanks, Dan. Looks like we are to our next polling question now. And that question is, the Paycheck Protection Program loan, does it reduce stockholder basis? Is it considered taxable in the year received? Is it not allowed if you claimed the employer retention credit? Or is it not taxable and increases stockholder basis upon forgiveness? Let's give everyone a few moments to respond to that polling question. In the meantime, Dan, we had a question come in asking if you could cover the requirements to qualify for that recovery startup business. Can you cover that briefly again, what the qualifications would be?
Sure. So that would be, Chris, if your business started operations after February 15th of 2020, and you have average annual gross receipts of under 1 million. So if you can check both of those boxes, you do not have to be concerned about the suspension of operations test or the significant revenue decline tests that are under the standard ERC program.
Thanks. Let's look at those poll results now. 87% of the audience say the PPP loan is not taxable and increases basis upon forgiveness. I believe that was what we were hoping for there, Dan.
That's it.
Okay. With that, we are going to move on and pass the torch off to Gigi, who is going to cover how the business meals deduction has changed.
Thank you, Chris, and good afternoon, everyone, and thank you all again for joining us today. As Chris said, we're going to spend a few minutes discussing the business meal deduction. Historically, business meals have been limited to a 50% deduction, but the Federal Consolidated Appropriations Act that was passed back in December of 2020 allows for meals that are purchased from a restaurant to now qualify for full deductibility in 2021 and in 2022. Obviously, this was passed to help stimulate the restaurant industry, but it is very advantageous for most all businesses. In order to qualify for the 100% deduction, the meal does have to be purchased from a restaurant, but it can be consumed either on site or off site. food and beverages purchased from places such as convenience stores, grocery stores, or liquor stores do not qualify for the 100% deduction. Items such as water, coffee, and snacks that you provide to your employees at your office are still limited to the 50% deduction. A few examples of items that will qualify if purchased from a restaurant for 100%, or is if, for instance, an employer brings in lunch from a restaurant for its employees for the convenience of the employer, can now be 100% deductible. And that would be, for instance, if, say, a CPA firm purchases meals from a restaurant and brings them to the office so that employees don't have to leave for lunch during tax season. So again, for 2021 and 2022, that would be 100% deductible. Additional meals that qualify for the increased deduction are meals during business travel, meals at a seminar or a conference, and also office holiday parties. This provision does not apply to meals from an eating facility located on the employer's premises. So for instance, a hospital cafeteria. You may want to consider getting with your controller and setting up a separate general ledger account in your books to track the meals that are 100% deductible. That would be separate from, say, your travel and entertainment accounts, so that you ensure on your tax return, your CPA picks it up separately and captures that deduction. And now we are going to talk a little bit about the American Rescue Plan Act. The American Rescue Plan Act was passed in March of 2021. While this act provided mostly for individual provisions, there were a few business-related provisions included. First, it extended the Families First Coronavirus Response Act employer credit through September 30th of 2021. Under the APRA, an employer could choose to voluntarily provide an additional 10 days, up to 80 hours max, of paid leave for employees who are absent due to the COVID-19. The credit still calculated the same at 100% of wages, up to $511 per day, or 67% of wages, up to $200 per day. But it basically reset the number of days that had previously expired or had previously been used up. But it also, in addition to offering time off for actual COVID-19 illness, the act expanded the credit to include a few other things. And that is time off for employees to actually obtain the COVID-19 vaccination, time off recovering from any illness related to receiving the vaccine, time off accompanying a qualified individual, say a child, to obtain immunization, and time off if the employee is caring for a qualified individual who's recovering from any illness related to the vaccine. Now, unlike the ERC, the question about self-employed people under the ERC, this credit does apply to self-employed individuals. So the credit is calculated for self-employed people at the lesser of $200 per day, or 67% of the average daily self-employment income. The average daily self-employment income is the self-employment taxable income for the year divided by 260 days. And this credit can be calculated on IRS Form 7202, and then it gets reported on the individual's 1040 where the Schedule C is reported. Under APRA, employers may also offer emergency family medical leave for all the reasons we just listed. Previously, under the emergency family medical leave, the credit was only available for leave needed to care for a child whose school was closed or caregiver was unavailable. But under this act, the first 2 weeks can be paid at 2/3 of the regular rate of pay. And it raised the maximum credit from $10,000 to $12,000 per employee. And now we're going to talk a little bit about the employer-provided dependent care assistance. An eligible employee's gross income generally doesn't include amounts paid or incurred by an employee for dependent care assistance when it's under a qualified plan, such as cafeteria plan. So prior to the passage of the ARPA, the amount that could be excluded from an employee's gross income during the year was not more than $5,000 for a married couple and $2,500 for married filing separate. For 2021 only, the exclusion for the employer-provided dependent care is increased from $5,000 to $10,500 for 2021 only. Employers do have to amend their current plan, but they have until the end of the current plan year, and it will be retroactive back to the beginning of the plan year. Amounts contributed to the plan by the employee get reported in box 10 of the employee's W-2, and they're excluded from FICA, Medicare, and federal taxes and wages. The carryover rules were also changed under the APRA for 2021 and 2022. So for an example, if an employee elected to contribute, say, $5,000 to a plan in 2020, but because of the shutdown, they only incurred $2,000 in dependent care assistance in 2020. $3,000 could then be carried over to 2021. The employee can then elect to contribute up to $10,500 to the plan in 2021. So amounts unused in 2021 can then be carried forward to 2022, only up to the maximum contribution amounts for 2020 and 2021 of $15,500. So that would be your $5,000 from 2020 and your $10,500 from 2021. As long as all of those are used, if all of the money is used in 2022 for qualified expenses, it will still be excluded from the employee's income. And Chris, I think that brings us to our next polling question.
Okay, thanks, Gigi. Next polling question is, under the American Rescue Plan Act, is the family leave credit extended through December 31st of 2020? Is the credit does not apply to self-employed individuals? Does it allow a credit for time off for employees to get vaccinated? Or does it not provide for an increase in dependent care assistance? Give everyone a few moments to respond to this polling question. And in the meantime, I had a question come in, Gigi. We hear in the news that some employers are offering incentives for their employees to get the vaccine. So if a company gives its employees $100 to receive the vaccine as a bonus, would that $100 be taxable to the employee?
That's an excellent question, Chris. And if you don't mind, I'm going to let you jump in on that one. I would say it's probably not.
Yeah, I would think it would be treated as any other bonus, so it would be taxable to the employee. Yeah, I don't know of any provision in the tax law that would allow that to be a tax-free fringe benefit. So my inclination would be that it would be taxable compensation to the employee. But that is a good question. We're definitely hearing a lot about that in the news these days with the push for the vaccine. So let's look at those poll results. 69% say the American Rescue Plan Act allows a credit for time off for employees to get vaccinated. I think that's what we're looking for there, Gigi.
Yes, it is. That is exactly right. It did expand those rules to cover time off for employees to get vaccinated.
Okay, great. Now, Gigi's going to cover some of the Small Business Administration Assistance Programs.
Yes, thank you, Chris. So we're going to, as Chris said, we're going to look at some of the recent changes through the SBA. Back in April of 2021, the SBA had increased the maximum loan amount, the EIDL loan amount from $150,000 up to $500,000. And then in September, and it was really because of the Delta variant, the SBA then increased the maximum loan amount up to $2 million. The SBA is authorized to make these increased loans through December 31st, 2021, or when all the funds are exhausted. So you can apply in different increments. For loans requested up to $500,000, and if the business was in operations before January 1, 2019, the maximum loan amounts, the lesser of the business's gross profit, so gross receipts less cost of sales times 2, or $500,000. It's the lesser of those two. For loans requested greater than $500,000, the SBA is going to underwrite the loan, but they will perform a cash flow analysis to determine the business's ability to repay both the EIDL loan and also other existing debt. So after that cash flow analysis, they will help determine your loan amount. And then for applicants that began operations partially through 2019 or 2020, the SBA will calculate your maximum loan amount for you. Recipients of these EIDL loans are now allowed to use the funds for all ordinary business expenses and to pay business debt that's been incurred either in the past or in the future. Previously, the uses were limited to items such as payroll, rent, and utilities, similar to those uses that were allowed under the first round of the PPP loan. There are a few restrictions on the increased EIDL loans. The funds cannot be used to expand your business. They can't be used to make prepayments on debt owned by a federal agency, including the SBA. They can pay debt, but they can't prepay it. And they cannot be used to start a new business. The SBA is requiring a personal guarantee on all loans over $200,000. And for loans over $500,000, a UCC1 lien is required on the business assets and also on the best available mortgage for any real estate owned by the business. These loans will have a fixed interest rate of 3.75%. And the payments will be deferred for the first 2 years. And then payments of principal and interest will be made over the remaining 28 years. During this deferral period, interest will continue to accrue on the loan. Another SBA program is the Restaurant Revitalization Fund. And this one allows for restaurants, food trucks, caterers, bars, bakeries, and other businesses in the food industry to obtain loans, and they are equal, this loan is equal to the 2019 gross receipts less the 2020 gross receipts less any PPP monies that have been received. Again, just like on the regular EIDL loan, the funds can be used for any business operating expenses and debt payments allowed. There is also what they refer to as a targeted EIDL advance. This advance offers eligible recipients up to $10,000, and it does not have to be repaid. But to qualify for this program, you have to be considered in a low-income community. The SBA actually has a link on their website to a map that you can type in your address and see if you're considered in the low-income community. You have to demonstrate more than a 30% reduction in revenue, and you have to have 300 or fewer employees. And then finally, there is a supplemental targeted advance, and this provides an additional $5,000 on top of the $10,000 under the targeted EIDL. And this $5,000 does not have to be repaid either. But to get the supplemental advance, you again have to be located in a low-income community. You have to be able to show an economic loss of more than 50% over an eight-week period, beginning on March 2nd, 2020 or later, compared to that same period of the previous year. And you also have to have fewer than 10 employees. So the supplemental advance is much more restrictive than the just targeted EIDL advance. And Chris, I think it's time for our next polling question.
Okay, thanks, Gigi. Polling question 5. The COVID EIDL loans allow for expanded use of the funds to include operating expenses and debt repayment. Is it loans up to $5 million, or is it repayment over 20 years? So give everyone a few moments to respond to that. And in the meantime, we had a question come in, Gigi. Those targeted EIDL advances, do those have to be repaid?
The targeted EIDL advances do not have to be, the $10,000 does not have to be repaid, nor does the supplemental. If you qualify for the additional $5,000, that does not have to be repaid.
Okay, thanks, Gigi. Now let's look at those poll results. 78% say the EIDL loans allow for expanded use of the funds to include operating expenses and debt repayment. Is that what we're looking for there, Gigi?
That is what we are looking for.
Okay, great.
Correct. Wonderful.
So now Gigi's going to cover the net operating loss rules.
Okay. So prior to, well, let me back up. The 2017 tax reform legislation, which is known as the Tax Cuts and Jobs Act of 2017, or sometimes referred to as the Trump bill, lifted the previous 20-year limit on net operating loss carry forwards. So it then became unlimited carry forwards. But it also limited the NOLs to only 80% of taxable income in any one given tax period. But the CARES Act that was passed in March of 2020 provides for a 5-year carryback of NOLs that are generated in years 2018, 2019, and 2020. The CARES Act also temporarily removed the 80% limit for NOLs that are generated in tax years 2018 through 2020 and allows the NOL to fully offset an organization's income. If you decide to carry the NOL back that's generated in 18, 19, or 20, it must be carried back to the earliest in the 5-year carryback period. So then if the earliest year does not have enough income to fully absorb the NOL, then the remaining NOL is then applied to the next carryback year, say your 4th year, if there's taxable income in the 4th year, and then 3rd year, 2nd year, and 1st year. So you can't choose which years you carry back to. And each company will really need to take the time with their advisors to assess their situation to determine if this NOL should be carried back or if the election to carry it forward should be made. Because often the extended carryback provision could provide a more favorable rate, say for instance for a C corporation, because they would be allowed to carry back to a period pre-2017, pre the flat rate of 21% being in effect. So they could be in a higher tax bracket 5 years ago from the NOL year. For pass-through entities, the individual rates need to be analyzed. So for instance, if an S corporation generated an NOL to a taxpayer in 2020 of $400,000, and let's say that taxpayer's effective rate in 2015 was 25%, then the cash benefit would be $100,000. But if that taxpayer anticipates that their tax rate in 2021 would be 35%, it would likely be more beneficial to carry forward the loss to 2021. And also the effect on any business tax credits need to be analyzed in determining whether to carry back or carry forward the NOL. Corporations that wish to carry back will either file Form 1139 or an amended return. And individuals file either Form 1045 or an amended return to claim the carryback NOL. While filing Forms 1139 and 1045 do provide for a faster refund, there are some time restrictions on when these forms can be filed, typically a year after the NOL year. So you'll need to check with your tax advisor to determine what is the best method for you to file and whether you should carry back the NOL or you elect to carry that forward. And Chris, I believe that brings us to our last polling question.
Okay, thanks, Gigi. Last polling question of the webinar. The net operating losses generated in which tax year can be carried back for 5 years? Is it 2017, 2019, 2021, or can NOLs not be carried back? They must be carried forward. Give everyone a few moments to respond to this polling question. And in the meantime, Gigi, we had a question come up. May help folks out with this polling question, but the question came in is, what will the carryback rule be for the taxable loss generated in 2021?
So as things currently stand, if an NOL is generated in 2021, we will revert back to the Trump tax bill rules, and it will only be carried forward.
Okay, thanks. So let's look at those poll results. So 57% said 2019. I think 29% may want to change their answer now. They said 2021. Yeah, I think what we're looking for there is 2019, wasn't it, Gigi?
And that is exactly correct. 2019 can be carried back for 5 years, 2018, 19, and 20.
Okay, great. So with that, we will cover briefly the Build Back Better tax proposals. And I'll cover these real quick with the remaining time that we have in today's webinar. First, to clarify, we mentioned earlier that there was an infrastructure bill that was passed through Congress this past weekend. That the Build Back Better and the infrastructure bill had been tied together. They decided to bifurcate or separate those two bills. So the infrastructure bill that went through Congress this past weekend left the Build Back Better proposal as still on the table. So we're talking about two different bills at this time. So we're still monitoring what Build Back Better may mean to businesses, but here are some of the business-related tax proposals that have been included in the Build Back Better bill. And also keep in mind, these are all just proposals. If you look back, really 6 months ago, there was a lot more in terms of tax revenue raisers in this proposal. Over the summer, it got trimmed down to basically in half. And then within the last month or so, it got trimmed down again. So Congress continues to trim it down. So we'll have to wait and see what actually makes it in the final version, if anything comes to fruition here. But here's what we currently know as being in these proposals. First, the corporate AMT, the alternative minimum tax for C corporations, that was removed back in the Tax Cuts and Jobs Act. This proposal would resurrect the corporate AMT. That corporate AMT calculation would be 15% of a corporation's adjusted financial statement income. It would not be taxable income. It would be financial statement income at 15% tax rate. However, as it's currently being proposed, it would only apply to corporations with average annual income in excess of $1 billion. That's billion with a B, for the last 3 prior tax years. So as you can see, even though the corporate AMT may be coming back, it will just apply to some of the largest businesses. There's also a stock repurchase excise tax. This would be on domestic corporations that buy back its own stock. It would impose a 1% excise tax on that stock beginning in 2022. This too would only apply to stock of companies that are on a established securities market, which means basically publicly traded companies would face this excise tax. The interest deduction, Congress likes to really go after companies, especially multinational companies that it thinks may be trying to circumvent U.S. tax law. So they've introduced or included a limitation on an interest expense deduction for multinational corporations. This would only apply if the multinational group has average interest expense of $12 million annually. It's proposed to be first effective in 2023. So we'll have to keep watching for that. The worthless securities deduction, change those rules so that any loss from a worthless stock or a worthless partnership interest would have to be treated as a capital loss, not an ordinary loss. How this would apply is capital losses can only be offset by capital gains. So if this comes to fruition, it would make some of those worthless security deductions maybe a little bit harder to realize. In terms of the international tax changes, and I said earlier that the Build Back Better proposal has been scaled down throughout the year. This is one area where it really hasn't been scaled down. Many of the foreign and international tax changes that were in the original proposal are still in the current version of that proposal. And this just goes back to the heightened focus on multinational corporations and those companies trying to shift profits overseas to lower their tax bill. Lastly, the net investment income tax, or NIT. It's typically been it's a 3.8% tax that only applies to, or has historically only applied to, investment income. There is a proposal in the Build Back Better bill that would also make this 3.8% NIT tax applicable to all pass-through income, not just investment income. So S Corp shareholders and partners in a partnership may be subject to 3.8% NIT tax, regardless of whether they materially participate in the business or not. This would be, if it passes, it would first apply in 2022, and it would only apply to those with married filing joint income over $500,000 or a single head of household with income over $400,000. Those are the major proposals that we see as they currently stand that would impact businesses. We will continue to evaluate the Build Back Better, see what is left in at the end of the day and what may be stripped out or added. The best way for you to stay up to date with what's currently going on is to connect with CRI on social media. As any new updates come out, we will push those updates through our social media channels. So if you don't currently follow us, or pick your platform of choice and make sure you follow CRI so that you can be sure and get any of those updates as they arise. Looks like we are running short on time here. So for all the presenters, myself, Dan, and Gigi, I'd like to thank you for your time today. Hope everyone has a wonderful rest of the day.